Traders, welcome to the channel. My name is John. We got Groot here, and we trade options. So we're covering a quick one. This is really simple. You will want to stay with this because it is a very key fundamental to trading options, especially for income. And I'm going to basically give you the dry definition stuff, and then I'll actually do two examples, one in Robinhood, and then if there's time, I'll do one in Tastyworks as well. But let's look at this. Put credit spreads are also known as put vertical spreads or put bull put spreads. Sometimes people just call them verticals and so on. So just keep that in mind. Put credit spreads. You're taking in a credit when you create this trade, and that credit is given to you from the broker, and you basically want to give it back to the broker at a lower value. So keep that in mind. Basically, advantages here, we are looking at the facts that, one, you can be away from this trade. This is my favorite thing. You do not need to sit in front of the computer, stare at it. Basically, a couple minutes, put the trade on, go do chores, go to work, whatever. You can do this from your phone. I love that part of this type of trade. Also, you can use a small amount of capital. It is risk defined, so you actually do not lose any more than the max loss that you set up on your spread. In most situations, there have been times there have been times where your broker will actually try and adjust this to get the spread sold. So you do want to be careful, make sure you're in a liquid market with good trading. But the more important thing is, as long as you're not trading on expiration day, usually you don't have to deal with this issue. Other things, this is a bullish assumption. Basically, when someone hears puts, naturally they think bearish, like it's going lower, but this actually means bullish. You are thinking the stock will go higher when you set up this trade. And it takes advantage of something called theta decay, theta gang style. This basically, though, does mean that the other Greeks are always in play. There are a lot of Greeks that affect the options pricing, so keep that in mind. Keep your risk in check. All right, let's talk setup. Basically, you are looking at selling the out-of-the-money puts. There is also a out-of-the-money put that you're going to buy, and that defines your risk. And the break-even calculation, really simple. You're basically taking the short strike, and you're minus the credit received, and that'll tell you what level the break-even is for your trade. So I'll explain that in just a second, but give you a simple example. Let's say the stock's trading at about $40 a share. Your short put, this first component, is maybe you sell the 35 put. So stock's trading at 40, sell the 35, and then you buy the 30 put. That's your protection. Then you're basically going to take in a certain amount of credit. Let's just say you take in $1 of credit. Well, if you go 35, which is your first out-of-the-money put that you sold, 35 minus the $1, that puts you at 34. So your break-even price on the stock trade would be $34 a share. So at expiration, as long as the stock is closing above 34 a share, you are break-even or higher and looking good on the trade. So bottom line, we just want to be above our short put, and if you are each day, you'll see a decay and a gain in the profit as you're trading. Man, coughing a lot. So check this out, put credit spread. This is the profit diagram, and essentially what you're seeing is the green line is your max profits as you are above your short put strike price, like we talked about. Break-even price calculated as your short put strike price minus the credit received. And then we also have risk defined. So you can see the red bar as it goes lower. Your max loss is determined by the spread width, basically the long put that you purchase. And let's get out of that and talk about the important things, such as, where are we? All right, so what we're looking at here is going to be, let's say, Riot. I'll just jump in to Riot here, and we're going to set this trade up. Riot blockchain. As we go to trade Riot options, we'll hit put, and let's go out further in time, maybe the next expiration cycle that's a monthly. So let's say May 21st. And as I'm looking here, okay, Riot is trading at $40.36. We got a $40 stock. And if I go here, let's just try and set up what we had talked about earlier. So if I go to the 35 strike, that's right here. $35 strike is trading at the 28 delta. And if I hit plus, that's gonna, oh, I don't want to buy it. Actually, don't forget to look at that. I want to sell this put. So I'm gonna sell it. That's my short strike component. And then what I want to do now is go to buy. And now I'm going to buy my protection. And that'll be, let's say, you could make it 1 or 2 points away. Let's just say I go like 2 points away. You'll now see my total credit would be 82 cents. I don't want that. I want to take in a little more credit, but I'm also taking on more risk by increasing the spread. So let's just say here I buy the 30 put now. So I bought the 30. This one's at like the 17 delta, but I bought that at $2.06, and you're going to see now I took in a credit of $3.95 for the 35 put. I'm actually paying or buying the 30 put, so the net difference between those two becomes $1.89, and that would actually be a credit I'd take on if I continued this trade here. So if I went here, one, boom, $1.90, and it would say I don't have enough collateral, but it would basically set me up here, and the collateral is the spread width, so that's a 5-point wide, and that would be what you need for collateral in this trade. So I'll set this up in Tastyworks as well. May 21st, boom, and actually the puts are on the right, calls on the left. So what I'm going to do is sell the 35. So I go to bid, click it, and that's 29 delta, about 28 on Robinhood. As I go to 30, this is the 30 strike, ask, boom, click it. So I shorted the 35, bought the 30 as protection, and you'll see here $1.90 is my credit. And essentially what I'm doing is I'm looking at a max loss of $310, max profit at $1.90. Theta decay here is about $2 a day, but it accelerates. So in a couple days, that becomes $4 a day. In a couple days, it becomes $10 a day, and so on. So that's pretty neat because it'll accelerate in order to meet that level. And if I go to analysis here, that'll actually show me how this trade looks. Ooh, let's see if it lets me. There we go. So on Riot, it's a little hard to see, but here's my short put, here's my purchase put, here is my break-even price, which was a couple dollars away. So 190. So let's do this. What was it? 35 minus 190. So that puts me at 33.1. So $33.10 would be my break-even price on this trade, and I'd taken $190 as credit. So that's pretty useful. I think that is something that's important for people to understand. You do want to be below where the stock is trading. As you can see here, you know, we're below the price where the stock is at $40 a share. We're trading below it to set up this trade, and we just want the stock to always be above this level, and if we do, we're sitting in profit at all times. So next video you're going to want to watch. It does explain spreads a little more in depth, but I just want to give you a quick and easy one so you can understand how to trade.